Turning savings into investments, the step-by-step path. Okay, picture this. You have finally done the responsible thing. You've been super disciplined, right? You're moving a little bit of money into your savings account every single month. Maybe it's $100 here, $200 there, and honestly, you should feel absolutely incredible about that. You're acting with real financial maturity, and I just want to start off by validating that discipline. Seriously, saving is a massive first achievement. But if you're tuning into this explainer, you're probably starting to sense that saving alone isn't really the final destination. You're ready for the next level. So how exactly do we take that beautifully disciplined saving habit and safely transition it into real, lasting wealth? Well, that is exactly what we are going to unpack today.
All right, let's dive right into this. Here is the incredibly frustrating reality that so many responsible savers end up facing. One day, you proudly open up your banking app on your phone, and you see that you have exactly $10,000 sitting right there in your savings account. Amazing. But then you look a little closer at the interest rate. It's earning something tiny, like 0.5% interest. Do you know what that actually means in real dollars and cents? It means that after an entire year of leaving your hard-earned 10 grand sitting in that bank, you've made a grand total of 50 bucks. Yep, $50 after a whole entire year.
And right there, that $50 reality just hits you. And this exact question pops into your head. Wait, am I doing this wrong? You hear your friends, your coworkers, and random people online constantly talking about investing, stocks, index funds, and compound growth. They seem to be building actual wealth, while your balance basically hasn't budged at all. Listen, it is completely normal to have this internal monologue, and ask yourself if you're missing something. Because the controversial truth is really just this. Saving money is good, for sure, but saving alone will almost never make you wealthy.
To fix this, we have to fundamentally shift our mindset by clearly defining the totally different jobs that our money has to do. On one hand, your savings are designed to protect your money. That is their one and only job. On the other hand, investments are designed to grow your money. A lot of people get stuck simply because they expect their savings account to do the job of an investment account, but they're two very different tools. Saving is incredibly important, but it's just stage one. To actually build wealth, we have to move some of that money over to the growth side. And simple compounding math brilliantly illustrates exactly why that shift is so urgent. Let's look at a 20-year timeline, assuming you start with that same $10,000. For saving, let's say you're earning maybe 1% interest. After 2 whole decades, you're sitting at about $12,200. But what about investing? Historically, the broader stock market has returned an average of about 10% per year over long periods. If your money was invested, earning that 10% annually, after 20 years, you'd have roughly $67,000. Wait, $67,000? It's the exact same starting amount of money, but a completely different outcome. This jarring difference, that is the massive cost of financial inaction. The biggest wealth gap out there isn't between savers and spenders, it's between people who save and people who invest.
So if the math is so glaringly obvious, why doesn't everyone just invest? Well, it's not a math problem at all. It's a psychology problem. Saving simply feels safe, while investing feels incredibly risky. When your money sits in a bank, you can log in and see it. It's static. It doesn't randomly drop 5% on a Tuesday afternoon. But investments, they move. They fluctuate up and down. And you know what? It is completely fair and totally valid to fear losing the visible, stable savings you work so incredibly hard to accumulate. That emotional volatility is exactly what scares people away. To really wrap our heads around this, I love this visual metaphor. Think of saving money like storing a bunch of seeds in a glass jar. You are perfectly protecting them. Absolutely nothing bad will happen to those seeds, but absolutely nothing is going to grow either. Investing, on the other hand, is like taking those seeds and planting them in the soil. At first, it looks messy. You're putting your pristine little seeds into the dirt, and you don't see results immediately. It might even storm. But over time, nature takes its course, things grow, and eventually that messy soil yields a massive, thriving garden that's far bigger than the original seeds you started with.
Now, because jumping straight from the safety of the jar into the messy soil is pretty scary, the transition should happen in carefully managed stages. Here is our 5-stage framework to confidently transition your money. Number 1, build an emergency fund. Number 2, separate your money. Number 3, start small. Number 4, choose simple investments. And number 5, stay disciplined. So let's break down step 1.
The absolute most crucial point here is that before you invest a single dollar into the stock market, you must have a real emergency fund. We're talking 3 to 6 months of your core living expenses saved in cash in a regular, boring bank account.
This money is not for investing. It's definitely not for jumping on some hot stock opportunity your buddy told you about. It is strictly for unexpected life problems, a sudden job loss, a random medical emergency, or a major car repair. Why does this matter so much for investing? Because the single biggest reason beginners panic sell their investments at a massive loss is simply because they need cash immediately. An emergency fund builds a fortress around your investments, protecting them from your own life emergencies.
Once that fortress is built, we move to step 2, which is honestly entirely mental. You need to separate your funds into 2 distinct buckets: safety money and growth money. Your safety money, that emergency fund we just talked about, does not move. Its job is absolute stability. But your growth money, your investments, is officially allowed to fluctuate. When you mentally accept that the actual job of the second bucket is to wiggle around and grow over time, it drastically reduces your emotional anxiety when the stock market does what it naturally does.
All right, now we're ready for step 3. There is a huge misconception out there that keeps so many people on the sidelines, and it's the idea that you need thousands of dollars to start investing. You absolutely don't. You do not need thousands. $50 works, $100 works. Your goal on day one isn't to make massive profits or perfectly time the market. Your goal is simply to build the habit. Consistently transferring a small amount into an investment account builds a lasting financial muscle that is far, far more powerful over time than trying to start with some intimidating massive lump sum. Okay, so what exactly do you buy with that $50? Well, that brings us to step 4. Beginners often make the massive mistake of jumping straight into complicated high-stress strategies, things like day trading, options, or crypto speculation. Just ignore all of that. The most powerful strategy is actually wonderfully boring. You want simple investments, specifically index funds. You see, an index fund doesn't try to pick one single winning company. It tracks the overall stock market. You are buying tiny slices of hundreds of top companies all at once. This gives you instant diversification, massively lowers your risk, and provides steady long-term growth. And if you're wondering if this boring strategy actually works, well, Warren Buffett, arguably the greatest and most legendary investor in modern history, has repeatedly stated that low-cost index funds are the absolute best choice for most investors. You really don't need to outsmart the market. You just need to own a piece of it consistently. When the greatest in the game tells you to keep it simple, it's definitely wise to listen. Let me show you the mind-blowing climax of that consistent strategy. Imagine you start investing just $300 a month into the market, and you just let it sit for 25 years at an average 8% return. Out of your own pocket, you contribute $90,000 over that time. But your compounding growth, that generates roughly $195,000 purely from the market working for you. Your total balance would be around $285,000. Your money made more than double what you actually put in. That right there is the literal magic of compounding. But I know what you're thinking. Right about now, a very loud, very persistent thought is probably creeping into your head. It's the elephant in the room. Okay, this sounds amazing, but what if I start investing and the market crashes? Look, it's a completely valid beginner fear. We all see the scary, dramatic news headlines with giant red arrows and people panicking on television. It totally feels safer to just retreat back to that glass jar of seeds. But here's how we completely reframe that fear. Market crashes and dips, they're entirely normal. They've happened dozens of times throughout history. But these market dips are actually incredibly beneficial for long-term investors. Why? Because when the market drops, that $50 or $100 you invest every month is suddenly buying way more shares at lower discounted prices. It's literally like your favorite index fund is on sale. When the market eventually recovers, as historically it always has, those discounted shares lead to even stronger returns. Experienced investors don't panic. They think in decades, not days, and they use that volatility to their advantage. Which brings us right to step 5, the final piece of our framework: stay disciplined. Listen, anyone can invest when the market is going up and the headlines are happy. But discipline is what separates true investors from gamblers. When the market dips, you have to stay calm, be incredibly patient, and just trust the compounding process. Remind yourself that you have your separate cash emergency fund so you are safe. Just keep planting your seeds regardless of the financial weather. So to wrap up our core lesson for this explainer, saving gives you stability, but investing gives you freedom. Neither is bad, and in fact, you desperately need both. By conquering the illusion that cash is the only safe place, and by strategically combining both of these tools, your cash fortress for emergencies and your index funds for compounding growth, you unlock an incredibly powerful financial future.
So, as we close out today, I want to leave you with a question to reflect on, and I'd really love for you to truly answer this for yourself. Take a look at your own finances right now. Are you currently stuck purely in the saving stage, protecting your seeds in a jar, or have you already started the messy, beautiful process of planting them in the soil by investing? No matter where you are today, you now have the exact step-by-step roadmap to safely take your very next step. Keep learning, stay disciplined, and I will see you in the next explainer.